good morning. Welcome to our kickoff panel on what's new in the AML landscape. For me, it's a pleasure, a true pleasure and a privilege to once again have the opportunity to serve as the moderator for this panel. I've been doing it for a number of years, and it's always, well, for one thing, it's always difficult to follow David, because David always has something in terms of a show that really makes it interesting. But it is a pleasure to be able to get together as the first panel to kick off this conference, which is such an important conference. We're also extremely fortunate again this year to welcome back our outstanding panel of experts. You have their bios and your materials, but we have Koko Ives from the Federal Reserve, Andrea Sharrin from FinCEN, Jim Richards from Wells Fargo, and Walt Mix, who is with the Berkeley Research Group in California, but is also the chairman of FIBA's sister organization, the International Bankers Associations of California. I imagine that most of you have seen the television commercial. It's an insurance commercial that basically has a little slogan that says, we know it all because that we know a thing or two because we've seen a thing or two. I'm sure you've seen that. Well, this is what this panel is. This panel knows a thing or two because they've seen a thing or two. And we're really fortunate that they can share their experiences with us. Every year we get together, and every year we try to come up with what are the hot issues or what are the hot topics that we can discuss. And we basically always come to the same conclusion that it's not so much new topics or new issues, but a continuation of existing issues that are always present in our industry and always present in the BSA area. But this year there are a couple of things that are new that we're going to hopefully talk about. One is that finally, May 11th is right around the corner, and the implementation of the new beneficial ownership rules kick in and take effect. And we've been talking about it for years, or at least for 18 months, but now is the time. The other thing that's very significant is that there has been changes of leadership in all the major regulatory agencies at a time when there's a renewed focus on regulatory relief and having AML BSA programs that are efficient and effective, but that offer some type of regulatory relief or relief from burden. And I think that's some of the things that David was talking about in terms of having more dialogue and more cooperation between the private industry and our regulators. This year we're going to do things a little bit differently. In the past, we've always had the speakers generally present a topic and then speak on that topic, and then the other panelists kick in. This year we're going to do it differently in that I'm going to ask questions of the panel and hopefully get some interactive discussion with respect to some of those issues or some of those questions. But before we start that, I do want to give an opportunity to each of our panel members to just spend a few minutes, maybe 3 to 5 minutes most, talking about what they're seeing in their particular agencies or organizations with respect to what's new. And in particular, with respect to Koko and Andrea, I'd like for them to address the changes in leadership in their agencies and what kind of implications, if any, that could have for BSA supervision and regulation. And by the way, just as a cleanup as well, I don't know where David is, but I assume that if you want to send in questions, you can go ahead and send in questions and we can ask for the panel as well. So with that, I'd like to turn it over to Koko to maybe talk a little bit about what's going on at the Federal Reserve.
Excellent. Hopefully you all can hear me. I want to start out by thanking Thor and Andrea and the rest of FIBA.
Do you want the shield in the
I may want the shield later, maybe for us, the regulators panel in particular, where we get grilled. But it's a pleasure to be here and to help kick off this conference. I wanted to spend just a few minutes on what's new in the Federal Reserve and maybe in the AML space. And you stole my thunder on some of the new leadership. We have a lot of new principles. We have a new chair at the Federal Reserve. I should start with, we have a new administration. And from that comes a lot of priorities and a trickle-down effect. But we have a new chair at the Federal Reserve. We have a new vice chair of supervision. After many years, we have a new general counsel. At all the other agencies, OCC, FDIC, we have new leadership, a new undersecretary of terrorism and financial crimes. So that's a lot of new principles in the AML space. And I think that over time we'll see evolving priorities. So in particular, a theme of effective and efficient regulation and supervision. Our chair, Powell, and Vice Chair Quarles have spoken publicly about the intent to have effective and efficient, smarter, leaner regs, supervision that hits the right amount of supervision for the size and complexity and risk profile of the entities, transparency and supervision. All of this should be welcome and good news for the industry. I just want to highlight one aspect of the Federal Reserve's new proposed risk rating for the largest financial institutions. That's for the bank holding companies and financial holding companies over 50 billion in consolidated assets, with three components focusing on capital liquidity, but the one I wanted to mention was governance and control. We have proposed guidance out as well, board effectiveness guidance, and just want to highlight that the board effectiveness and AML issues could drive or impact that governance and control component of the LFI risk rating. I also just want to highlight that financial innovation is fintech in general, fintech companies, is something that for the last couple of years the Federal Reserve has been reviewing. It's a system initiative, so in combination with their 12 reserve banks and cross-section of expertise, AML experts and payments experts and so forth, we are interested in how financial innovation will impact our supervised entities, what role they play, the different legal and policy implications depending on whether the touch point to our supervised entities is partner, vendor, direct customer. We've been working not only internally with our 12 reserve banks, but domestically across the federal banking agencies and with FinCEN on financial innovation considerations. We've been meeting with fintech companies, and we also are very involved internationally on a host of initiatives, again, looking at the implications, what this might mean for how banking operations will be in the future, and then correspondingly how that transcends to different supervision. So I'll leave it at that. My themes were new principles, evolving priorities as a result of our new leadership. I think by this time next year, we'll have a far clearer view of what all that new leadership meant, and the themes of effective and efficient supervision and regulation. We'll be hearing more about that, and of course, fintech.
Great. Koko? I'm sorry, Andrea, sorry.
I could go again.
Sorry, Andrea.
No. I'd also like to start by saying thank you to FIBA, to Dave and to FIBA for the invitation to be here. This year and every year, it's a really great opportunity for us to share ideas and talk to each other. Not only talk at folks, but also listen and hear what folks are saying. We have, of course, new leadership. Our undersecretary is Sigal Mandel. And finally, after quite a while, we have a new director at FinCEN. His name is Kenneth Wonko. And I can say I've known him for a long time in my prior career at the Department of Justice. And I can say how lucky we are to have both of them in their commitments to public service and their commitments to doing what is good and doing what's right, particularly in this space. If you've heard Sigal, the Undersecretary, talk, you will know that one of her, can you hear me now? Can you hear me now? One of her priority areas is thinking about and taking action on regulatory reform. We've all talked about how the BSA has been around for a number of decades. There's been changes in the way that crime is being committed. There's been increasing burdens on industry associated with compliance costs, but there's also new technology that could make reporting better and higher quality and more efficient, that could reduce costs and provide information that could be better for law enforcement. So we're taking a hard look at those issues and really trying to understand it and think about what changes might make sense. What regulations are good where they are, but maybe we could clarify what they mean through guidance. Do we need to change? So we're really thinking about those issues. We're also focused on this discussion about FinTech, RegTech, and what that means in the context of regulatory reform. We are, with my colleagues in Treasury, I and other folks at FinCEN have gone out, we have met with companies, educating ourselves on the issues more deeply to understand how they will influence our thinking as policymakers and as, in FinCEN, the administrator of the Bank Secrecy Act. Another key area I think that we are focused on, that the Undersecretary and our Director is focused on, is increasing information sharing, which dovetails into some of the technology issues, but also thinking about those issues from an enterprise-wide basis. We've had financial institutions ask us, can you give us some relief from the regulations so that we can share with our foreign affiliates? And we have the authority to grant that relief, and we have done that in at least one instance, and I know that we'll be getting other requests as well. So that's sort of the landscape of how I see it and how I think we will be impacted by some of our new leadership.
Great, thank you. Jim, do you want to add anything?
Yeah, thanks, Al. And again, my thanks to FIBA and for having me here again. It's always nice. This is the audience participation section of the program, guys. I would like every BSA officer and every AML officer to stand up, if you would. If you're a BSA officer, AML officer, would you stand up? Come on, guys, participation. Stand up, stand up, stand up. Don't clap yet. Keep standing, keep standing. If you've been the BSA officer in the institution you're in right now for more than 2 years, keep standing up. For more than 4 years as the BSA officer, keep standing up. For more than 6 years, keep standing up. More than 8 years, keep standing up. 10, 12, keep standing up. How many are there? 4, 5? Thank you, guys. So I'm in my 13th year as BSA officer at Wells Fargo. It's 4,500 days, but I'm not counting. It's a very difficult job, and I honor all of you that are BSA officers. I thank you for your participation in the industry and what I think is one of the toughest jobs out there. So new developments, Al. FinTech is a new development, and I think it's because the banking industry missed the technology revolution. Let me run through 8 things that happened in 2006, 2007, and 2008. They didn't exist before 2006. Facebook, Android, iPhones, Hadoop, Twitter, IBM Watson, LinkedIn, and Bitcoin. So all of those things did not exist between 2006 and really took off 2008 timeframe. The financial industry was in the middle of a crisis in 2008, so we missed it. We missed all of the technology revolution, and that's why I think FinTech and RegTech is the big thing right now. But the last time I saw a change like this was after 9/11, with new participants in the financial industry, in the AML industry after 9/11, and I don't think we did a great job back then, and I would like to take advantage of what we learned back then today, and it's this. The technologists are subject matter experts in technology. They are subject matter enthusiasts in AML. AML people are subject matter experts in AML, but we're enthusiasts in technology. So we need to bring the enthusiasm together with the expertise and just do a much better job leveraging each other's strengths and overcoming each other's weaknesses than we did after 9/11. That's the big one. The other big revolution I see in this industry is what it means to be an expert. And Thomas Friedman, in his, what I think is the best AML book written in the last 3 or 4 years, is not an AML book. It's Thomas Friedman's Thank You for Being Late. And if you haven't read it, I would recommend it.
What's the title, I'm sorry?
Thank You for Being Late by Thomas Friedman. And in it, he writes, it's not about knowing the right answers, it's about asking the right questions. So with all of the technology that we have, there are plenty of answers out there. And I think that the new definition of expertise, particularly in the AML space, is around knowing the right questions to ask,
Sure.
not having the right answers.
Yeah, knowing what to ask, absolutely. Actually, we're going to have, later on in the program, we're going to have a little bit of discussion about artificial intelligence and technology, which I think will lead into some of the things that Jim is talking about. Walt, did you want to add anything? What's going on in California and in your organization?
I'd love to. First of all, thank you to Thor. I particularly, there must be a inner surfer in David with that long blonde hair hanging out at the beach, and certainly we have those in California. So good morning, my name is Walt Mix. I'm a recovering bank regulator, okay? I was the superintendent of banks in California for a number of years and had the pleasure of working with people at the Federal Reserve, FDIC, people from other countries. Last year, I flew 1.5 times around the globe, according to my American Airlines statement. And I like to say that I see what's happening below the waterline. That would include, of course, Latin America, Europe, Middle East, Asia, few places like that. You might ask, so what am I seeing below the waterline? Well, quite a few things. The first and foremost thing that I'm seeing is banks are being hit from all angles. All you have to do is read the American Banker, Wall Street Journal, other publications. In the last year, it's not just BSA AML, but the same sorts of concepts. Everybody knows what a look back is? Heard of a look back? Okay. That's being applied to multiple areas of banks. Issues like customer harm, and we're talking about very small amounts of money that were allegedly not properly paid by a financial institution to its customers, things like $20, $80. But the similar concept to what we've seen with BSA lookbacks is now being visited upon other areas of the financial institution. Also, CRA is really back with a vengeance. So as I say, banks are being hit across a very wide front. Governance has been a big issue. The Federal Reserve has been talking a lot and has put forth a proposal with respect to governance roles. Maybe we can touch on that. I worked on the transition for the administration with the Treasury Secretary a year ago, and I can tell you that while I'm hopeful with respect to regulatory reform in the BSA AML area, I'm not really optimistic that it's going to be achieved in the near term. I do think, however, the technology platforms and things like RegTech, as was mentioned, can create a very positive momentum toward the types of efficiency and effectiveness. Everybody's read the Treasury reports. I'm sure some of us
They wrote it.
down here have
They wrote it, probably.
Well, there's one with regard to Dodd-Frank and stress tests and the like, which is somewhat different. But those seem to be accepted from the BSA AML area. We have regulations in the state of New York with regard to BSA monitoring. We have cyber regs up there that are being put forth. We have regulatory orders, U.S. Bank and Mega Bank, and also Rabo. In California, we have legalized marijuana, which is creating all sorts of issues. And as was mentioned, we have FinTech. FinTech is presenting a whole host of issues for banks. And I'll just leave it there. Perhaps we'll get into that a little bit later.
Okay, great.
So thank you.
Thank you. By the way, I got up because we are getting some questions from the audience, and some of them are already covering in part of the program, and the rest hopefully we'll get a chance to cover. So what I'm going to do is I'm just going to bounce between sitting down and taking a look at these questions. But perhaps we can get started on the issue of what's related to regulatory relief, and that is that we've all been waiting now for 18 months for the final rules on beneficial ownership to actually become effective, and now May 11th is right around the corner. And so one of the things I'd like to ask the panel, and hopefully, even though I'll ask it of one person, that everyone will chip in and provide their input, is how prepared do you think the industry is now that May 11th is right around the corner? And what challenges do you think we still face? And maybe we'll start with Jim.
Well, we've seen the beneficial ownership rule coming
For a long time.
for a long time. Actually, 2006 or 2003, if you were actually really paying attention and don't have a life outside of BSA. But you know, nothing has really changed too much since 2014. And if you actually look very closely at some of the OCC's BSA-related consent orders going back to Citibank, JP Morgan in 2013, 2014, to US Bank in 2015, some other big bank also in 2015. Every single one of them had a beneficial ownership requirement, even though there wasn't a final rule. They referred to the 2011 guidance on beneficial ownership. So the industry has been seeing this for a long, long time. I think most of us are pretty much geared up. Our technology is done, our training is done, our policies are done, our procedures are done. What's not done, I don't think, is the awareness of the customer. And that's going to hit the customers, and then when it hits customers, it's going to hit the media, it's going to hit Congress, and I expect that there will be a little bit of forbearance and some change coming up.
Actually, I think banks in South Florida in particular, I can't speak for banks in the rest of the country, but I think banks in South Florida are very well positioned in terms that they have been collecting information on beneficial ownership at the 10%, not at 25%, but at 10% for years now. And this is basically best practices among the banks here. So, Andrea?
Yeah, I think, you know, can you hear me on this now?
No.
Can you hear me on this? Yes, I can hear me on this. From our perspective, we have heard from industry that that folks are really pretty much ready and there. There's some lingering questions, including when are the FAQs coming out, and I keep saying soon, and I feel
had
like
a question on that. I didn't ask it on purpose.
I know, and I appreciate that, but and it feels like every time, you know, I'll be ready in 5 minutes, but it starts every time you ask me. But we do anticipate them getting out pretty soon. There are some lingering questions, like what about if I have been doing 10% all this time, you know, and now it's 25, should I change it? Do I not have to change it? What should I do? And, you know, and there are other, and I'll answer that, and there are other questions that have come up, and what we've tried to do while we're waiting for the FAQs is to kind of try to answer some of the bigger questions that have arisen to the extent that we were able to do that. And, you know, the rule is pretty clear that that what you have to do is meet the threshold of 25% ownership, right? If you can move from 10% to 25% and meet your obligations, I think that there will be times for customers that come in, you might think to yourself, you know, in considering all of my obligations and doing due diligence, yeah, I think I'm going to want to do something closer to 10% here. But, you know, beneficial ownership is only one piece of it, right? So there might be other things that will get you to doing your due diligence better than beneficial ownership at 10%. And that's something that institutions will have to consider and, you know, understand the risks associated with it and what are they going to do, you know, what can they do to meet that particular situation. But the rule is 25%, so you're not obligated to go.
Yeah, that's actually a question that a lot of the banks in South Florida have had. And perhaps it's an appropriate question for the panel that follows this one, which is ask the examiners. Because there's always, you know, the concern that there's a disconnect between what comes from Washington and what the examiners will do on the ground. And one of the concerns that has been expressed by a lot of the banks in South Florida is particularly that if they're at 10% and then suddenly they decide to go to 25%, that they will be viewed as weakening their system rather than just following the rules. So it's, I appreciate your comments, and it'll be interesting to see what the examiners have to say about that as well. Koko, did you want anything?
Yeah, I'll just say quickly that the expectations would be consistent as always if a firm is changing procedures and policies. We would be, you know, we would expect some sort of documentation and rationale around that. Nothing new, that's what we would always for any fundamental change. The rule, FinCEN's rule that the federal banking agencies will examine for says 25%. We are also hearing that industry has developed new systems, that they've trained staff. That's you know, encouraging and all good news. I just want to add that the federal banking agencies are also training examiners so that there'll be a consistent approach in examination. We hope to begin that soonish with incorporating it in regularly scheduled annual interagency FFIAC trainings. So there's one in July, we may have one before that. We will continue to train our examiners throughout the year on this rollout for the new rule.
And when you say training the examiners, you mean on an interagency basis, so it'll involve all the different agencies?
Yeah, on an interagency basis through webinars, in person, additional federal banking agency only trainings through a whole host of different means.
Okay.
Yeah.
Walt, what are you seeing in California?
Well, Al,
I'm sorry.
I'd add one other thing.
Sure.
We're very focused on the implementation of the rule from a CDD, customer due diligence perspective. Don't forget about all of the peripheral stuff that is going to be impacted, either immediately or through, no disrespect intended, regulatory drift, as sort of the regulatory expectations drift. So take a look at your SAR systems, take a look at your customer risk rating. What does it mean if you have a single beneficial owner as a beneficial owner of 5 different customers? Do you risk rate those customers differently now? What about your CTR systems? What about your OFAC systems, your sanction systems? All of the peripheral stuff around, I think, is the more vexing issue that you're probably facing in 2018.
Walt?
What I would add is we're seeing a lot of M&A activity around the country. The expectation is that with the thresholds in Dodd-Frank very likely to rise, the Senate bill says $250 billion for the threshold on stress testing, just to simplify it. So we're seeing a lot of M&A activity. Be careful on your due diligence. Be careful when you're engaging in new products. Be sure you create a new risk assessment. Think about new concentrations, silos that you may be creating. Those types of issues arise in this type of environment. And that as things change, the business model changes, the risk profile may change. I'm aware of one situation where an institution bought another bank out of state and didn't spend enough time looking at some of the concentrations that were arising, and they got in real trouble with regard to BSA AML at the next exam. So stay on top of those types of issues.
Okay. Well, following up or continuing a little bit with the beneficial ownership rules, hey, one of the questions that I have, and it's really more, I think, for Koko and for Andrea, but obviously you guys are welcome to chip in, is how do you see the new rules adding to the effectiveness of the overall overall program. And there's a number of things with the final rules that caused some people to pause. For example, the fact that you don't aggregate ownership, so that if you have a father and 4 sons, each owning whatever 10% of a company, that you don't aggregate it to go over the 25% threshold, as you would for control purposes of the Bank Holding Company Act. The fact that trusts are not included as entities for purposes of determining or requiring beneficial ownership, where most of the banks in South Florida already collect information on beneficial ownerships on trusts. So given some of those, I don't know if you call them issues, but just some of those situations, how do you see the overall effectiveness? What do you think the final rules will do to the effectiveness of a program from a regulatory perspective?
To the extent, and the intent was another valuable piece of risk assessment information, and to the extent it shines a light on shell companies and the heartbeat behind the companies for greater financial transparency, so that banks may be able to arm themselves to reduced instances of being, facilitating money laundering. That's the greater intent. The benefits of maybe greater fraud detection, better compliance with OFAC sanctions, whatever else that it may shine on, could make a stronger, more effective anti-money laundering program. I think we have to live with the rule a little bit and see how it shakes out. I think that it was workable because there is no requirement that banks obtain and maintain percentages of beneficial ownership of all their legal entity customers that would be insurmountable. And thankfully, that's not what it asks for.
So I think it's always good to take a step back, right? Why do we have, the bank secrecy? What's the purpose of it? What's the purpose of these programs, right? We're wanting to detect and deter and prevent, terrorist financing, money laundering, and the crimes associated with it, right? And one significant issue that law enforcement has faced is the ability of criminals to hide behind shell companies and remain anonymous and conduct transactions through our financial system without anyone knowing who they are. So a rule is always going to try to balance the burden to industry, the need for law enforcement, the need to achieve the purposes of the Bank Secrecy Act. And I think that this will be a very key and important component of an AML program that will greatly assist financial institutions when companies are opening accounts, because it is a critical piece of information that wasn't there before. I think Koko is right. You got to live with the rule. If there's one thing I learned, any rule requires guidance, and any guidance requires more guidance. So, and
Such as FAQs.
As such as FAQs, we're getting a sense of what questions are most frequently asked. And we will give that guidance, and it will be ongoing, right? We will live with the rule a little bit. It's a big change. It's a shift. And as time goes on, we will, a lot of the questions will be answered, I think, in the FAQs, but I'm certain that they will raise other ones. And we will endeavor to provide guidance on those questions that come
Sort
up.
of a peripheral question on that very topic. There's a strong sentiment, I think, among a lot of people, including a lot of bankers, that maybe today the U.S. is the least transparent of a lot of the countries in the world, in the sense that you can set up corporations in Delaware and Nevada and other places where you don't have to provide virtually any information at all. And I know that's not really so much of a federal question as it is a state question, but are you aware of any movements at all to address? I know at one point FinCEN tried to, or wanted to do something to create a database. Has there been any movement in that regard?
I think there's some proposed legislation. It's been ongoing for a long time. What will happen with it? who's to say, in this, with this Congress administration and what their priorities are and what they want to move forward. But, FinCEN has always been committed to working with the Hill on those things, and will continue to do so. I think it is an issue that requires congressional action. There's nothing we can do as regulators on, beneficial ownership at company formation. I think that is a legislative question, but, we are there to work with Congress and help talk about the issue with them to arrive at something if they choose to move on it.
Yeah, and I mean, ultimately it is up to the states, I guess, to a great extent. Jim or Walt, do you guys want to add anything before we move on?
No, let's move on.
No, I guess Walt does.
I just had one comment. Don't forget the other 4 pillars. Oftentimes what we see in our consulting projects is a focus on one pillar that may be coming up as a particular issue, and resources shift to that pillar, and then we forget the other 4, including in particular staffing and audit. The audit issues that we've seen in BSA in the last year have been fairly scary because the regulators have said that the audits haven't been sufficient in many, many cases. And that's across the board, FDIC, Fed, OCC, and states.
I'll just point out, you mentioned the other 4 pillars. We don't have anyone from the OCC up here, but FinCEN has created a 5th pillar. The OCC does not have a 5th pillar. They stayed with the 4.
That's interesting.
They didn't change their regulation. There's only 4 for the OCC. And so the beneficial ownership, sort of the new CDD 5th pillar, you're not going to find it in the OCC regulations.
So I can speak to my brethren,
Okay.
federal regulator.
Because that's a very important point, because I know we have a lot of national banks out in the audience.
So currently, none of the federal banking regulators are contemplating changing our regulations to independently have issue the beneficial ownership regulations. We will examine for them, but what's in a name? If folks, Jim, you're getting hung up on the whether we call it a 5th pillar or not. I don't know if that really is code for if there's a deficiency, how we will bring an enforcement action. I just want to clarify that nothing in the FinCEN rules that we will examine for changes how we bring enforcement actions as far as the importance or whether it would rise to enforcement action. It's still a holistic view of the anti-money laundering program and the deficiencies, whether those are systemic, how far back they go, how far-reaching throughout the whole program. So it doesn't matter what you call it if that's
right.
really what you're worried about. Whether it's a 5th pillar, for FinCEN versus it, suspicious activity monitoring hasn't risen to we don't call that a pillar. CIP, we don't call a pillar. CIP is, anyway. So hopefully that has cleared up that it's just a name. We look at a holistic approach, and it will not change traditionally how we bring any kind of actions should there be a need for one.
Okay, so the takeaway from this is it may not be a pillar, but you better be doing it come May 11th. All right.
Comply with all your BSA regulations.
So changing topics a little bit. The advances in artificial intelligence technology have really created systems for more effective and efficient AML, BSA monitoring and programs by far. But one of the issues, of course, that comes up is that the larger institutions have a distinct advantage over the smaller institutions because they can afford all these systems, whereas smaller institutions have a harder time. And I know Andrea suggested perhaps a layaway plan for some of the smaller institutions, but it can be difficult. And so I guess the question that I have is, do you foresee, and this is I guess really for everyone, but I really would like to start with the regulators, do you foresee a situation where these types of artificial intelligence and technology will become best practices so that all institutions will be required to have them and implement them, just like everyone had to go from manual monitoring to electronic monitoring of accounts? And obviously understanding the burden that puts on smaller institutions. And maybe we can start with you, Koko.
So the expectation is that suspicious activity monitoring and systems within a firm are commensurate with the size and complexity of the firm. So there is no explicit requirement for an automated system. It's just banks have evolved in ways we hadn't contemplated in 1970 when the Bank Secrecy Act went into effect, more global, more complex. To that extent, the systems have to be commensurate, right, with the size and complexity. So the short answer of, the domestically federal banking agencies are not requiring through reg or expecting through guidance a fintech solution in order to comply with the BSA regs. Having said that, we are reviewing, as I had mentioned, the Federal Reserve and all the federal banking agencies, the real potential for, and also risks involved in artificial intelligence and machine learning, sifting through for purposes of transactional activity and suspicious activity monitoring, getting smarter, better, more accurate, less false positives, translating to firms being able to allocate resources more, better, more efficiently. Those are all pluses. However, the financial institution can establish its own systems to be commensurate with its operations. So hopefully that addressed the question.
Yeah, I think Koko has it right. It's, it certainly is not something that is, required or will be required, I would imagine, anytime in the near future. We're still, at the early stages of understanding its benefits. And how it can be used, maybe how it can be used cross institution. So there's a lot of things that we're learning about it, and I don't see that as happening anytime in the near.
Becoming a best practice where it would be required on institutions?
Right.
Okay.
I think
Okay.
it's very premature to think of it in those terms. But let's check back in a few years.
Okay. Jim, and I know you're big on artificial intelligence technology.
Yeah,
as
we've
part
been
of the
running
program.
AI systems for 9 years now. It's really not that new, but I think that, to me, AML at its core is, it's a subjective feeling that an analyst has based on intuition, empathy, judgment, etc. And technologists hate all that. They hate empathy, they hate intuition, they hate judgment. They want it to all line up and, it's technology, it's bits and bytes, right? So AML is not classical music where you have 60 pages and every note is perfect and you want to play it perfectly the same way every time. It's much more like jazz, where you have one page you can play for 20 minutes and it's never going to be the same way twice because it's intuition and empathy. It's a subjective feeling at its core. And I go back to sort of the subject matter experts, subject matter enthusiasts. We have to blend that intuition and expertise of the true AML professional with the sort of technology expertise of crunching through the mass amount of data that we need to get through.
Okay. So, Walt?
So this is where I have a lot of optimism for banks and BSA AML. We have actually implemented it in a number of institutions, from large global institutions with a global footprint and USA operations, all the way down to community banks. The benefits that we see include not just more efficient and more effective BSA operations, but also marketing intelligence, because at the end of the day, the banker can get to know his or her customer at a much deeper level. One of the banks where we're assisting with this, they've been able to understand their market more deeply, attract additional customers from nearby banks, and from a strategic perspective, I think through the Darwinian process, that banks are going through where they're competing against each other and non-banks and fintech companies. This can create a real advantage for banks vis-a-vis pricing, risk management, and other types of things. At the end of the day, what I like to think of when I think of artificial intelligence, and it kind of goes back to what was mentioned previously, it's all about the tailoring to the specific risk profile of the financial institution. And it's an iterative process. It's not just flipping on the old light switch and it happens automatically. It's something that has to be thoroughly implemented throughout an institution's risk profile. Also, I'd like to point out, I think that a better description for artificial intelligence really might be enhanced intelligence, but it doesn't really have that Silicon Valley buzz to it. So I think we may be stuck with AI for a while.
Andrea?
With respect to whether it's something that's new or been doing it for a long time, I think it is something that some institutions have been doing for a long time, but I think its relationship to AML, and as we think about reforming aspects of AML and its application within and across financial institutions, I think is evolving, and we're looking at in a new way than we have in the past.
I think, Al, we're all really keen on embracing artificial intelligence and machine learning and big data, and there's probably only about 10 of us in the room that actually know what those things are. So you really have to make sure that you're not getting oversold on the technology side of it.
Yeah, that's a big risk.
Yeah, it can be a really big risk. So make sure you really understand why you're buying it, what it is, what you're going to do with it.
Now, a number of institutions actually going to monitoring systems, thinking that they were improving or hoping to improve their monitoring systems, actually got themselves in more of a mess because they didn't fully understand how to implement the new system.
Yeah.
So
So
that's a good point.
that's actually key. I was going to say that for whatever new innovation at all, the expectation is that the firm have folks that really understand the inputs and the rationales and whether the results are meaningful. And if your operations change and you need to adjust the monitoring system or whatever fintech latest service that you have, that it's really important that you fully understand it. I mean, the liability is with the firm, not with the service provider. Sure. And one last point from me on financial innovation generally. The regulators do not want to be an impediment to financial innovation. And to the extent that we are reviewing our rules to be more streamlined, to be more calibrated and precise, to measure the actual risk involved, we will take a look and make sure that they are, since they predated most of the financial innovation, that they're not sort of clumsy and bump up against, as an example, an evolving concept of identity, digital identity, for purposes of customer identification program is one example. And make sure that the reg is sufficiently flexible to allow for innovation and that it's not an impediment.
Walt?
Just one quick follow-up comment. Most of the banks in the room are not G-SIFIs, right? So what we're doing is we're working with the bank service corporation companies. We all know who they are, so that the system can sit on top of an existing platform, and that really goes a long way toward mitigating the vendor risk and other types of risk that go along with installing artificial intelligence. And again, it has to be tailored and fitted like an excellent suit or other garment to the specifics of that institution.
And one last point. So we've got, I hope I can say this, roughly 3 million cases in our system right now, AML cases. So we have a pretty good set of data to work with and to learn from. By far, the best sources of really good SARs that law enforcement has interest in are referrals from human beings.
Not for machines.
They are not from machines. So do not forget your people. And if you're going to spend $100, I would spend the $100 on your people and not on another machine.
That's a good point. Good advice. So, moving along. I think we all agree that the bad guys are generally 1 or 2 or 3 steps ahead of almost everyone. And the systems constantly have to evolve in order to be addressing new issues and emerging issues. And so I wanted to get a sense from all of the panel as to the best practices in terms of how do you identify and how do you prepare for emerging threats in the AML BSA area. And maybe start with Jim, since he left off.
How do you prepare for emerging threats? Well, first of all, you can never be satisfied with where you are. Always try to look ahead, anticipate where the industry is going, because what you're building today, you're going to be judged on 2 years from now based on standards that haven't yet been set. So you have to somewhat anticipate where the industry is going and where the technology is really going. So, I think what's really interesting right now is a lot of the negative news screening that we're all doing. And that's a very, very, very blunt instrument right now that we have. Yeah. It's a tremendous amount of data, and mining social media to learn about your customer, understanding where negative news comes from, understanding what I call the denominator of negative news. So there might be the sort of the screaming headlines, but you have to look at everything to put the screaming headlines in perspective. So I think negative news screening is sort of one of the next frontiers. Okay. And the other one is we're very focused on transaction monitoring. But to really understand AML, you have to look at the interactions that your customers have, not just the transactions they're doing. So how many times are they checking their balances? Where are they checking them from? What devices are they using? Who are they talking to? So it's the interactions that you have. There'll be twice as many interactions as transactions. And I think that's the next evolution. We won't be talking about transaction monitoring 2 years from now. We should be talking about interaction monitoring.
Interaction as opposed to transaction monitoring.
Yeah.
Okay. Koko?
So I have a recommendation for three things that I think firms can do for the next big scandal, Panama Papers, cybersecurity, whatever it's going to be something. So one, be informed. Two, be prepared with clear procedures. And the last one, you can't underestimate the power of comprehensive customer due diligence, knowing your customers and the risks they pose to the organization to the extent possible. So be informed, read FinCEN alerts, stay abreast of congressional hearings and congressional reports, the negative news and internet searches Jim's referencing, FATF lists for AML, weak jurisdictions, read the newspapers for areas of political turmoil, and public sources like Basel Institute and Governance also rates countries. So that's the be informed. The be prepared is know who in your organization is responsible for going through customer files and seeing how much of exposure you have to whatever scandal of the day. Know and have a clear understanding of how that gets escalated. Will that be just a customer review of whether the customer due diligence information is complete and accurate and updated in a meaningful manner? Will you be looking at beneficial ownership review? Will you be looking at whether there's a well-documented source of wealth? Understand the scope of the review. Is it just customer files? Is it a transaction review to figure out your exposure? And then the last again is knowing your customers and doing the due diligence necessary. I think with all those, you could better ensure that you will have a timely and effective response to the newest, latest scandal threat.
Right around the corner.
You know, and one thing that we can do, that government can do to assist you, that we try to do at FinCEN, Koko mentioned FinCEN alerts. What we try to do is we get information from law enforcement. We get information from financial institutions who file SARs. And financial institutions in many ways really are on the front lines in what they are seeing, and there are some that may see it before others. And when we receive that information, have that information, we do try to, you know, develop red flags for the rest of the financial institution and put out advisories to let you know what to look for in particular situations, or what we're focusing on, or what you might want to be focusing on.
Okay. Walt?
So I think of the answer to this question in two ways: the outside and the inside of the institution. Inside, I hope everyone has a risk management committee, an enterprise risk management committee. I hope that it's meeting regularly. I hope that BSA is an integral part of what that committee does. I hope that you take excellent minutes. And one real takeaway here is what I call mining the minds of some of your key employees in your different product areas. That's a very important way of discovering what might be happening in the lending area and also in the deposit area, and making sure that you aggregate that kind of information and listen to what those frontline individuals at your institution have to say. Listen to that regularly. In terms of the outside, meet with your regulators, okay? Go see your regulators. Do that throughout the course of the year, perhaps quarterly. Also, I would recommend having an outside informal group of people with whom you speak. Maybe it's people in the technology arena, your lawyers, accountants, outside consultants, and create a multidisciplinary group. You'd be surprised the things that you can glean through dealing with those types of people, because one of the things we've found over the years is something may happen on the East Coast and then it makes its way to the West Coast or vice versa. So those are some ways of thinking about identifying emerging issues.
Okay, thank you. There's an issue, I guess the de-risking issue is an issue that has been around for a while. And one of the areas that has been of particular significance, particularly to South Florida, has been correspondent banking. And the fact that banks from Latin America and from the Caribbean are still virtually finding it impossible to establish correspondent relationships with US banks. And obviously, we all know that they need to have access to the US banking system. And so a lot of them go underground. There's nested accounts that are used and so forth, which would go contrary to everything I think we would want to accomplish in terms of BSA and AML. So I wanted to just follow up, and I know, Koko, you've spoken about this before, the kinds of initiatives, if any, that are going on. I know that there are some initiatives that you've been involved with to try to address this issue.
Sure. So there are different international initiatives that the Federal Reserve have been a part of, and same with the other federal banking agencies. Treasury leads the Financial Action Task Force, FATF, has been way deep in de-risking issues. The CPMI, the Committee on Payments and Market Infrastructure, collection of central bankers coming together also to look at this from a payment side. We issued a report making recommendations that have been picked up through these other organizations. The Basel Committee on Banking Supervision, the AML Experts Group, the collection of international supervisors coming together to see how they could scope and understand the issue and provide guidance. And the Financial Stability Board has an oversight correspondent coordination group that takes all the pieces and all the initiatives from the ones that I have mentioned, that we participate in all of those, and has a 4-part action plan to sort of get at the problem through different ways. So, and I will run through them quickly. There's data collection is 1, clarifying regulatory expectations is 2, technical assistance and training is 3, and then enhancing tools for due diligence. It's 4 different ways to get at the problem. The data collection is to scope, are our initiatives helping? Is it getting worse? Is it getting better? It's looking at SWIFT data and international payments to see what's happening. Ultimately, through reports, you probably know that global payments are the same. It's a consolidation. So we know that the decline in foreign correspondent banking is hitting the regions unevenly, especially the ones that you've mentioned. I would say, jumping to the technical assistance and training, the Federal Reserve personally has anti-money laundering training throughout the world, and in particular in 2017 we had a training in the Bahamas, we had a training in Panama, we had a training in Mexico with the host of the Caribbean jurisdictions. It was a training for the supervisors of those jurisdictions, and it hit I have a list of the countries I won't go through, but all the areas that you're talking about, in an effort to better communicate to those supervisors the expectation, anti-money laundering, global standards through FATF, domestic U.S. expectations, in an effort. Those are the respondent banks that are getting de-risked, so that the supervisors are clear and understanding. The clarifying regulatory expectations, FATF has good correspondent banking guidance issued in 2016, and since I've been here, we at the Basel AML experts group, the international supervisors, have new revised correspondent banking guidance I urge you to look at. That's part of a broader, very good, guidance on sound management of risks for money laundering and terrorist financing. What those guidance pieces do well is make clear that there are a spectrum of risks within correspondent banking, and that banks should treat them as such. Some need a lighter touch than others, and it's just more nuanced and a more thoughtful approach. One of the new initiatives is through FATF in coordination with the Basel AML experts group, are surveys to determine in jurisdictions, are those guidance pieces well publicized, and are they implemented and used in communicating to banks how you can view risk, how there are sound management practices to identify and control the risk. And those guidance pieces talk about not only responsibilities for the correspondent bank, but what the respondent banks can do to get banked. What are some sound practices? And in addition to our participation in training, we we contribute or participate in the Treasury-led public-private dialogues that hit the jurisdictions in particular that you meant, and many more jurisdictions. I guess I will end with the, you all may know, the Wolfsburg Group has revised their customer due diligence questionnaire, a collection of the largest global banks that have come together. The questionnaire isn't new. It started out with 29 or so questions. The most comprehensive one that's launched, that is out as of February, is over 100 questions. For purposes of onboarding in correspondent banking, having to do with the legal structure of respondent bank and products and services offered and geographies served, as a standardized set of questions for onboarding for purposes of due diligence. And that initiative was welcomed through all these organizations that we're a part of, FSB, FATF, Basel AML Experts Group, that it is an excellent starting point for customer due diligence. Starting point because due diligence is ongoing, but it's a good collection. It also helps respondent banks be very clear on the expectations, what's going to be asked, what's important for assessing risk. So these are just some of our recent initiatives for correspondent banking. We hope with the four-step approach that we can begin making inroads in, at first, stem the decline, and then ultimately help those that haven't been banked ultimately be banked.
And I hate to harp on this, but those initiatives are great, but unless they filter down to the examiners, to the people that are on the ground, then you're still going to have the situation with the local banks being hesitant to assume that kind of risk.
So one last point, and then I'll let everyone else speak, is excellent point, and we have examiner training. Federal Reserve, every month we have phone calls with our examiners, being clear on expectations inside Washington, sharing what's going on in the international community, as well as yearly training, as well as the interagency efforts through FFIC, where the federal banking agency examiners are trained together. But we have been very careful and have tried in the last several years in speaking engagements, in any communication through guidance, in our revising our FFIC BSA AML exam manual, to be very even-handed in not to facilitate any type of de-risking by calling out any particular type of business, service, country, and to be even-handed. So that is part of our effort through examiner training and how we communicate.
Okay. Walt, I'm just curious, you see the same issues with the Asian banks in California?
So one of the things we're seeing on the West Coast and throughout Asia, and I had the great pleasure of going there a few times last year, the banks are really risk averse, the banks that I'm dealing with. And, reputations of certain agencies precede themselves as the examination crews go around. So since I deal with multiple regulatory agencies and banks of all sizes, I can tell you that bankers think about shopping, state and national charter, and do I become a Fed member, or do I stay with the FDIC? It's pretty much the same treatment and same tone across the board. So that's what we're seeing. Some banks, however, are willing to step up and put in place the risk management that's necessary. But of course, what they'll do is they'll pass on those costs to the customer. Oftentimes, what we'll see in our reviews that we do for banks is they'll de-risk customers, and those customers will go over to a nearby bank, and banks don't communicate about those customers who have left with the succeeding bank that's going to take on those customers, and so the process starts all over again as those customers are onboarded somewhere else. Well, that's the kind of thing that we're seeing.
Well, that's where you hope that banks would take advantage of 314Bs to communicate among themselves to try to get information.
There's many times they're happy to get rid of those customers and, don't really communicate about it.
Yeah.
So I
To
think,
be blunt.
the conversation that we're not having with our regulators is I've never had a regulator say to me, Jim, we really appreciate you guys banking that really high-risk customer class. And so we know there's going to be a little more suspicious activity, but don't worry about it because we really appreciate it. So it would be great if we were given some forbearance or understanding for financial inclusion purposes, that yes, you can bank MSBs, you can bank Ecuadorian banks, you can bank Caribbean banks. We know they are, or we believe they are, inherently higher risk. We get that. But we would sooner have you guys banking them, and an American bank running American dollars, and you're monitoring them. And there will be unusual suspicious activity. We get that. But we're not having that conversation yet.
No, we're
and if
not.
we could have that conversation, if there was an upside, that would be great.
If I could just mention, yesterday at the meeting, there was a technology presentation, and one of those companies is working to provide a exchange system whereby banks can communicate about correspondent banking and other customers in a secure platform. I think if you mix that with artificial intelligence, you can go a long way toward sharing information and having the type of due diligence performed before onboarding a particular customer or a particular group of customers.
But you need to season that dish with some regulatory forbearance, or else
Exactly.
it's not very tasty, right?
Exactly.
Will work. So I had a lot of questions, and we're almost out of time. I see on the monitor here we have just a little bit over 4 minutes. So I'm going to just add a very broad-based question to each of the panel members, and unfortunately you only have like a minute to respond to them, but can you share your experiences as to what you perceive to be best practices in putting together an effective and efficient and reasonable program?
I want to
Well,
highlight.
that's easy to do in 4 minutes.
Yeah,
It's easy, piece of cake.
you just took up my 30 seconds. Okay, FinTech. I think that there is a way, and we have seen banks onboard deliberately, slowly, understanding the level of risks and appropriately managing to those risks by taking on a FinTech company, whether it's pricing appropriately for the ongoing monitoring, having senior management buy off, having extensive enhanced due diligence, and I'll leave it at that. There is a way to do it. You know, we welcome that, understand the risks, and manage those appropriately. It can be done. We've seen it.
Andrea?
I think those are all great points, and I would just add to them, instead of reiterating them, that always keep in mind the end goal of what the AML program is about. And it's about providing the information that we then use, right, to detect, to deter, and prevent criminal activity, and to support law enforcement investigations into terrorist activity and money laundering and other serious crimes. And I think, you know, that is an important thing to always keep in mind. And you know what? We actually listen to some of these things that folks are telling us, and we hear you about regulatory burden. And what Jim just said about, you know what, we need to know from regulators that, you know, you want us to bank, you know, certain kinds of higher risk types of customers. And that's okay. And let's figure out where the line is between banking higher risk customers and facilitating criminal activity, and make sure we fall short of the latter. And those are things that we want to think about, and, you know, really commit to being better about providing, you know, guidance and information to help in those discussions.
Jim?
I'm super excited about, you know, the next few years in our industry. I think we've turned a corner from really having a lot of competing interests, you know, the regulators, law enforcement, private sector, technology, and now we're starting to bring sort of different perspectives rather than competing interests to the problems we're facing. And I think the next 2, 3, 4 years are going to be, we're going to see some tremendous, very positive gains in our industry. I think it's a great time to be doing what we're doing.
Well, that's the way it should be. It should be a partnership. It should be a
Absolutely.
partnership between the industry and the regulators.
Yeah, we could
without
do so
question.
many great things. And, you know, the financial inclusion piece, I think, is a really nice addition to the way we're thinking. And not just big banks, but, you know, the migrants that are working in our communities. And I think we've got a great opportunity.
Great. Walt?
So, in a couple of things. In California, as I mentioned earlier, recreational marijuana is now legal, right? But the problem is, the problem is banks can't receive those funds, right? So as you would think based on economics, the money flows where it would naturally flow, right? So it's going around in trucks and vans, and it's being delivered that way, basically. So here we are, ironically, in an era of fintech and regtech, and we have cash being taken around because banks can't onboard it in vans and trucks and whatnot, okay? So no small irony there. The other thing I would say as a takeaway is something that Jim mentioned earlier. You know, to me, at the end of the day, banking is still really a people business, notwithstanding all the technology and regtech and artificial intelligence. But I'm really optimistic that we can work together with the regulators, with the technology industry, and the banking industry to create a solution to these problems.
Great, thank you. How about that, David? Look at this, okay? So please join me in thanking our panel. This was great and a lot of very useful information.